oil to go up through the end of the year.
Oil prices are up after a surprise announcement from OPEC.
A surprise announcement by OPEC and Saudi Arabia that they will cut more than 1 million barrels of oil each day.
The rift has opened up between Saudi Arabia and its Emirati allies over a crucial oil deal.
In a world driven by global energy demands, the oil market continues to captivate the attention of investors and analysts alike. Recent developments have set the stage for a fascinating narrative of rising oil prices. Join us as we delve into the data from reputable sources and explore the multifaceted factors that have propelled this surge. Oil prices react to Saudi warning and tightening supply. On Wednesday, oil prices experienced a mixed session, with gains being partially reversed. However, they remained robust due to several key factors. Firstly, U.S. inventories and fuel supplies tightened, sending a signal to the market. Secondly, a warning from the Saudi energy minister to speculators raised the possibility of further output cuts by the OPEC Plus alliance. Let's delve deeper into these developments. U.S. inventories and fuel supplies tighten. The tightening of U.S. inventories and fuel supplies had a significant impact on oil prices. Brent crude futures saw an increase of 74 cents, or 1%, reaching $77.58 a barrel. Meanwhile, U.S. West Texas Intermediate crude WTI rose by 84 cents, or 1.2%, reaching $73.75 a barrel. Saudi warning raises prospects of OPEC Plus output cuts. The warning from the Saudi energy minister sent shockwaves through the market, raising concerns among short sellers and signaling a potential for further output cuts by OPEC Plus at their upcoming meeting on June 4. Edward Moya, senior analyst at Awanda, stated that oil is starting to turn bullish after the Saudi threat to short sellers and emphasized that Saudi Arabia is determined to defend prices. Industry data confirms falling U.S. crude oil and fuel inventories. The bullish sentiment was further reinforced by industry data revealing a sharp decline in U.S. crude oil and fuel inventories. Market sources, citing American Petroleum Institute (API) figures, reported a decrease of approximately 6.8 million barrels in crude inventories, 6.4 million barrels in gasoline inventories, and 1.8 million barrels in distillate inventories. Potential impact on U.S. gasoline inventories. Should the data from the Energy Information Administration, EIA, expected later today, confirm the API figures, U.S. gasoline inventories would have declined for the third consecutive week, reaching their lowest pre-Memorial Day levels since 2014. This could potentially alleviate recessionary concerns, as highlighted by Awanda's Edward Moya, market wary of U.S. debt ceiling discussions. While oil prices received a boost from these factors, broader market sentiments were tempered by ongoing U.S. debt ceiling discussions. The recent round of talks ended without any signs of progress, raising concerns about the possibility of default if the government's borrowing limit of $31.4 trillion is not raised. Negotiators for Democratic President Joe Biden and Republican Speaker Kevin McCarthy are expected to reconvene today to address this critical issue. Inflation data and implications. Another factor affecting price rises is the latest inflation data from Britain, which showed a smaller than expected decrease in the stubbornly high inflation rate. This data has raised the likelihood of more interest rate hikes, contributing to the overall market dynamics, bullish sentiment, and future outlook. In conclusion, despite the mixed trading session, the warning from the Saudi energy minister, and the tightening of U.S. inventories and fuel supplies have instilled bullish sentiment in the oil market. Investors are carefully monitoring the potential for further output cuts by OPEC Plus and eagerly awaiting the confirmation of declining U.S. gasoline inventories by the EEI. Later today, the Memorial Day holiday in the United States, which marks the start of peak summer travel and higher fuel demand, adds to the anticipation. However, it's worth noting that the lack of progress in resolving the U.S. debt ceiling issue continues to cast a shadow over the market. The impasse between the two parties, as highlighted by Speaker Kevin McCarthy, has raised concerns about a potential default if an agreement is not reached. These recent developments have contributed to the fluctuating nature of oil prices. While the warning from Saudi Arabia has triggered a relief rally, Some analysts remain cautious. Craig Earlham, senior market analyst at Awanda, suggests that traders may be tempted to question the Saudi threat based on past experiences. Furthermore, factors such as China's slow economic recovery, the Federal Reserve's interest rate hikes, and the ongoing uncertainty surrounding the debt ceiling negotiations continue to weigh on the overall outlook for oil prices. In summary, the recent tightening of U.S. inventories and fuel supplies, coupled with the warning from the Saudi energy minister, have had a significant impact on oil prices. The possibility of further output cuts by OPEC Plus and the confirmation of declining U.S. gasoline inventories will play crucial roles in shaping the market's future trajectory. However, uncertainties surrounding the U.S. debt ceiling discussions and other geopolitical factors add complexity to the situation. Investors and market participants will closely monitor these developments as they navigate the dynamic world of oil markets. In a world driven by global energy demands, the oil market continues to captivate the attention of investors and analysts alike. We've just explored the recent developments that have propelled a surge in oil prices. From the tightening of U.S. inventories and fuel supplies, to the warning from the Saudi energy minister, each factor plays a significant role in shaping the market's trajectory. Now, we would love to hear from you, our viewers. What are your thoughts on these recent events? Do you believe the Saudi warning will lead to further OPEC Plus output cuts? How do you think the declining U.S. gasoline inventories will impact the market? And what about the ongoing U.S. debt ceiling discussions? Share your insights and opinions in the comments below. We value your perspective and look forward to engaging in a meaningful discussion. Remember to stay informed and keep an eye on the ever-changing landscape of the oil market. Thank you for joining us today, and we'll see you next time on the Geopolitics.